All right, well, don't have a huge group today, so hopefully it can be more interactive, and if you have specific questions. I will caution you, most of the really complex leases and really specific questions, I don't have the whole standards memorized, and as those questions come up, I'll be the same as you. I'll be doing research, but we are happy to do that. We've had quite a few clients reach out with some of the, and really it's one of those situations where you've seen one lease. There's so many different extension options and termination options, and whether it's month to month or so many different ways they can set these leases up, and they can be pretty complex. But we're happy to help with that. So first, are my slides showing? Where'd the IT guy go? I've got it showing on my computer here. Does anyone know how I get it showing up there? Huh. Okay. Well, we'll wait till he's.
The last speaker danced a jig and slides.
Okay. Is that last speaker here?
Well, I think he's wanting you to do it.
I thought that might be the case. So I've got it pulled up on my computer. But there we go. Thank you. All right. So yeah, Lease is almost here. As I was preparing for today, I started going through the slides and realized I have way too many slides for this amount of time, and made the decision that really I want to focus on key takeaways, the most important things I want you to take away from this. Because like I said, going through a bunch of detail, it's not going to help with your specific lease or leases, and your, how much are you actually going to retain if I go over a bunch of specific examples. So really I want to hit the highlights and really focus on what do you need to know right now and what should you be working on. And if you're with a larger hospital system, you're a public company, you've probably already implemented the new lease standard a couple of years ago, so this is nothing new to you. So my focus is more on those who have not implemented this yet. So that would be most of the nonprofit hospitals and government hospitals. And really the key takeaways are going to be that you really should be working on this right now, because if you haven't implemented it yet, it's coming up, depending on your year end. If you're a June 30 government, it's coming up in just a couple of months. June 30, 2022, it is effective. The rest of the entities, if you have a different year end, or if you're non-government, your first year of implementation for this is a little later, but not that much. If you're a calendar year end, whether you're government or non-government, it's effective this year, 2022. So you don't have that much longer to get ready. You should all be working on it right now. So that's the one takeaway. The other takeaway is just kind of the basics of what this new standard means. I'm sure you've heard about it a little bit before, but just want to make sure that maybe the primary goal is I don't want you to get to your audit or your end of the year when this is first effective. You should not be saying to your auditors, what new lease standard? What are you talking about? Your auditors aren't going to want to hear that, and it's going to delay your audit, because if you get to that point, they're going to come back to you and say, okay, we've got a lot of work to do, and either they're going to need to work with you on a project, or you're going to have to go back and do a lot of work. And eventually I'm going to get to my slides, but I did a couple of board presentations of completed financial statement audits last week or the week before. And before each presentation, I kind of flipped through the financial statements, trying to get an idea of how much of an impact is this new standard going to have, because I wanted to kind of give them a heads up. And in 2 or 3 of the cases, they only had $20,000, $30,000, $40,000 of leases or lease expense that they were showing. So based on that, I kind of concluded it's probably not a big deal for these hospitals. But if you're already making that conclusion, I do want to caution you that one of the biggest changes is going to be where you have a kind of a mixed contract where you might think you're only paying for the supplies, But if there's equipment that goes along with that, for example, a chemistry analyzer in the lab, the agreement might be set up where they're saying you're only paying for the what's the word? It's not the contrast, but the consumables for that analyzer. The contract says you're only paying for that, but if you're getting the use of that equipment, it meets the definition of a lease. And so you actually do need to be accounting for that equipment and allocating the cost between the supplies and the equipment. So if you happen to have a lot of that, you may have a small amount of lease expense that you're showing on your financial statements, but you may still have a material amount of leases that need to be recorded. So just something to consider there. So I'm going to start going through the slides, and again, based on the time, I really want to get to the end and talk a lot about the implementation and what I recommend that you be working on right now. I'm going to be splitting it up between FASB and GASB because there may be, or maybe I should just ask up front, how many government hospitals do we have represented? 1, 2, and the rest are nonprofit or for-profit? Okay, so we do have a mixture. I kind of expected that. DZA, we do work with, I don't know what the percentage is, but quite a few from both. But I will say there's kind of one key difference between the standard that FASB came out for the non-government entities and what GASB came out. There's one key difference. Almost everything else, there might be some differences in wording, but most of the rest is the same. So I think what I'm going to do is if you can, even though this first section is going to say GASB, if everyone just follows along with that, I'll try and point out the key difference, but most of the details I talk about are the same, GASB and FASB. So big picture, you will be recognizing more assets and liabilities on your books. That's the big change. The focus is really on the operating leases. So currently you already record for capital leases, you have assets and liabilities on your books, but not for operating leases. With the new standard, those operating leases also will be recorded with some exceptions. If they're short-term leases, you have the option to not record those. So you can see some of those changes. Balance sheet will change. Expenses shouldn't change very much, if at all. It should increase transparency. I know it sounds like it's just a lot of additional work for not a lot of benefit, but it should help eliminate some of the differences where you could have two completely identical hospitals with all the same assets and operations and same size building, and one may be using a lot of operating leases and the other is purchasing things, and their financial statements could look very different. With this new standard, bringing those assets and liabilities on the books, you should be able to make a better apples to apples comparison between like facilities. So one thing to keep in mind, and I'll mention this again at the end when we talk about implementation, but this could have a substantial effect on some of your financial ratios. And these are some of the key ones: working capital, also known as the current ratio, debt to equity, return on assets. If these are used very heavily in your organization, especially by your lenders or creditors, you'll want to at least do some back-of-the-napkin calculations right away to see if this is going to affect some of your debt covenants, perhaps. The reason why these will be affected, again, as I said before, it's not going to affect your income statement as much, but on the balance sheet, and I'll show examples of what your balance sheet is going to look like in a little bit. But on the asset side, it's all going in non-current. At least the way the accounting standards are set up now, there's not really a current portion of depreciation in the assets. So everything that's capital assets, property, plant, and equipment, as well as these new right-of-use assets under the new lease standard, it's all going to be in non-current assets. While on the liability side, just like you have with your capital leases, you do break it up between the current and non-current portion. So by bringing all these new leases on the books, your non-current assets are going up, but on the liabilities, it's split between current and non-current. So that's why it's going to affect some of these ratios that, some of the ratios are only looking at non-current liabilities, or I guess if it's total liabilities, your liabilities are going up, but it's also affecting the ratio between current liabilities and current assets. So I mentioned that. So look at those debt covenants, and creditors are going to understand, they're not going to penalize you for a new accounting standard affecting your ratios, but you do need to make sure they're aware of it. So your first step is going to be doing an inventory of all your leases, and then doing some rough calculations of how it's going to affect those ratios. So GASB versus FASB, we'll start by looking at GASB. Here is the key difference I mentioned. GASB is using a single model where basically all the leases are going to be accounted for as you currently account for capital leases. That's an easy way to summarize it. FASB, on the other hand, is still going to have two different types, and that's the basic difference. And on the expense side, the operating leases from FASB are still going to go into one lease expense category, so just the same as you do now. So on the expense side, it should look very much the same on the FASB side. So that's, again, the non-government. On the government side, those operating leases are going to look very different. Although they'll different from now, but it'll be the same as what you do for capital leases. So just to clarify again, make sure we're all on the same page. When I say FASB, that's for the nonprofits and for-profits, basically all non-government. And GASB, that's the public district hospitals, county hospitals, or component units of county hospitals. So if you're reporting to the state auditor's office, you're reporting to the state government, then you're probably falling under GASB. Oops. Okay. Key thing, the effective dates, if you are a government, so that's also, I guess, another key difference is the effective dates. So government, it is coming sooner. If you do have a non-calendar year end, June 30, 2022, that's the first ones that this is effective for, and then September 30 and December 31st. While FASB, it's a little later, December 31, 2022 is the first ones it's effective for under the FASB side, the non-government side. Any questions so far? I forgot to mention that. If you have questions on specific effective dates or just anything I'm going over, feel free to stop me at any time. Okay, the lease definition. So when you're looking at your contracts, trying to decide if it is a lease, it conveys control of the right to use another entity's non-financial assets as specified in the contract for a period of time in an exchange or exchange-like transaction. So to convey the control of the right to use the asset, it needs to have both of what's shown there, the right to obtain the present service capacity and the right to determine the nature and manner of use. So some examples I was thinking of for that in some of the leases I've looked at for some of our clients. One example was a therapy department using the local community center's pool, but if you read carefully the agreement, they didn't get the full use of the pool for a certain number of months or a portion of the pool. They just got to use the pool. So other people could be using the pool at the same time, and it was only for a certain number of hours, I believe. But if it didn't meet that definition. So based on our reading of that contract, they did not have the right to obtain the whole service capacity of the pool, and they couldn't determine the nature and the manner of use. They just had access to the pool, basically. Another example was a portion of a building. So actually, this comes directly from the standard itself, I believe. If you're just given a generic, for example, part of a storage building, and they say you can use some of our storage building, but it doesn't specify what part of the building, according to the standard, that would not apply. But for example, if you're leasing the first floor of a building and you have sole use of that first floor, that does apply. So just trying to show some of the distinctions there. So yeah, depending on the specific lease type, and this is where it starts getting into the details where, yeah, you're going to see a lot of, and especially with this new standard coming out, the people developing these leases, they're going to try to find ways to make it appeal to you more, and they're going to make it more and more complex. So just recognize that and feel free to bounce ideas off of us or have us help with the research on that. So applicability, I said, it does need to be a non-financial asset. So some types of assets that are excluded would be intangible assets, assets under construction, where the underlying asset is financed with conduit debt, and leases that automatically transfer ownership of the asset. If it automatically transfers at the end, which does not include, even if there's a dollar purchase at the end or some nominal amount, that doesn't meet this last criteria. But if it automatically transfers ownership, it's a purchase. And so in that case, you record the asset, not the right of use asset. You record the asset itself and the liability, just as you would with any financing where you're borrowing from the bank and using those funds to purchase an asset. So the initial recognition, to say it as simply as possible, you calculate the present value of the payments. That's the lease liability. The asset is really a derived number where it should equal the lease liability unless you're making additional payments at the beginning of the lease. That would be the only difference. So if you make an upfront payment or some kind of implementation payments, they also mention in the standards initial direct costs, but they exclude most of the costs such as debt issuance costs. The main ones they include would be commissions, if there's like a broker helping with setting up the lease, or incentives, if you're, for example, an incentive to a tenant to, if you're taking over that lease from another tenant. Things like that would be included in that asset, but not debt issuance costs. So I don't think that's going to apply very much. So the larger items or more common items that will be included would be upfront payments. Otherwise, the asset and the liability recorded at the beginning will be the same. The lease term is one of the more complicated parts of these new standards, and this is very similar between GASB and FASB. They do want you to consider all the potential extensions or termination options within the contract. They say to use, reasonably certain. I think in GASB I couldn't find a good definition of that, but it is a pretty high threshold. On the FASB side, in the glossary, they did define it as, I think it was either 90 or 95% certainty. So we're talking pretty high level, but it's really considering all the different factors, such as how often, historically, do you usually exercise these options to extend your leases? How do the market rate or the rates in the contract compare to current market rates, as well as what you expect the rates to be in a few years at the end of the lease? And also just, as far as your organization, how costly is it going to be to cancel this lease and get into another lease? And it depends if we're talking a small piece of it. So considering all those options, you have to come up with, and I'll show you, we've kind of developed a pretty simple spreadsheet, and you can look at ours and come up with your own if you want, but I'll show that at the end. The basic idea is you want to inventory all your leases, and probably for the more complicated ones that have all these extension terms, document each of those terms and document your conclusions. Why are you deciding you are reasonably certain or not reasonably certain? And you're going to want to do that because 5 years or 10 years down the road, you're going to want to be able to look back and say, why did we decide? Why did we account for it this way? Why did we think we were going to exercise that extension? So you're going to want to do that up front, and especially in the initial year of implementation, where you're not doing it. It's going to be easier as you go, as you get 1 or 2 new leases every month or every few months. but at the very beginning, you're doing it for all of your leases at once. So that's really going to be where it's going to take a lot more time to go through those leases and document those considerations. One thing for both GASB and FASB, this is a very important thing to pay attention to. A lot of lease contracts, both the lessee and the lessor have the option to terminate the contract at any time. And under both standards, if that's the case, you don't include those terms. And this is the one area where I think some of these vendors might try to, I guess, find a workaround if they're wanting to entice you by not having you have to record these leases. This is the one area I think that we might see a lot of that, because it states very clearly in both standards, if both parties have that option. Under FASB, it explains it as the contract enforceability. Basically, it defines a lease contract as having to be enforceable, and it says if both parties can terminate the contract without the approval of the other party, you don't have an enforceable contract. So it's kind of the same idea under GASB. And you would consider, so it might say that you can terminate the contract, but you have to give 60 days notice or 180 days notice. You would include that notice period, because at least that's non-cancelable and enforceable. But beyond that period, you would not include any of that in these determinations as to whether you record the lease and how much you record it for. So what is the term of the payments that you're recording? So we talked about the reasonably certain. You use all the relevant factors. Some examples, as I mentioned, is there an economic incentive or a disincentive as far as having to cancel the lease and find a new source for that asset? Your history of exercising the options. Short-term leases, under both standards, there is an option. I think in GASB, it's not really listed so much as an option, where FASB, you would actually disclose that this is our accounting policy. In the notes to the financial statements, you would state that you've elected to use this policy. I think in GASB, it's more straightforward, that it says if it's a short-term lease, then you don't follow this new standard. But in either case, we're looking at short-term leases, and so it would be anything 12 months or less, but it does say you don't consider that probability of extension when you're considering that 12 months. So even though it might say it's only a year, if it has an option to extend, you do add that on, so it would not qualify as a short-term lease if it has that option to extend. However, you do still need to look at whether there's that termination or cancellation option from both parties. So just to make sure I was clear on that. So the short-term leases, you can exclude from this new standard. And that might be another way where vendors try to keep you from having to worry about this new standard by keeping it to 12 months or less. I mentioned this before, separating the lease and non-lease components. There's probably more of these than you think might exist, and this is where you're really going to have to get a lot of people involved, and your auditors are going to be considering this as probably one of the higher risk areas for implementing this new standard. So it's going to be looking at your maintenance agreements, supplies, training, services, because in many of these cases, that's what the wording on the contract says, is it's a maintenance agreement or a service agreement. But if it comes with equipment that you're getting the access to use for a specified period of time, it meets the definition of a lease. And so, it's probably not something you're going to be able to do just on your own or just, with your accounting staff. You will need to work with other department managers so they can go through their department and see, okay, these are assets that are recorded on our books that we've purchased, and it might be a good idea to if you have a regular process of inventorying your property, plant, and equipment. I know some long-term debt requirements require you to do that. But if you're not currently doing that, it might be a good idea to do that, because that way you can find, so here's what we actually have recorded on our books because we purchased it, and what's this other equipment? Where did we get that? Why do we have it? And those might be some of the areas where you might find leases that you wouldn't have necessarily recognized as being leases. So I mentioned the chemistry analyzer and reagents example. I think I've also seen where you might be getting surgical supplies or orthopedic surgical equipment, some of the screws or something, and you might have a contract where you have to buy a certain number of those a month, but if you're also getting some kind of equipment to use along with that, you do have to consider that as being a lease. And the way you do that, you have to look at the two different components. The lease component would need to be capitalized. I thought I had a slide. Maybe it's in the FASB section. Anyway, the basic idea is you look at the standalone cost. As much as possible, you try and separate the two and say, if these supplies were being purchased by themselves, they would cost this much, and same for the equipment. And then based on that weighted average, or just the percentage between the two, you allocate that to the actual amount you're paying each month. If it can't be done, there's no reasonable way of doing that. The standard, I think, to be conservative, says they'd rather have you put something on your books than nothing. So instead of leaving it all off, or anyway, it says the entire contract is considered a lease in that sort of situation. So as much as possible, you want to try and find those standalone prices so you can be more accurate and only put on the books what should be on the books. The lease liability, I mentioned this earlier, the basic calculation is just the present value of the payments. There are a few options. If it's a very straightforward lease, and I think the example coming up fits that description, if it's just set payment per month for a number of years and you've made all the determinations of whether there's going to be an extension or not, you can do that calculation in Excel very easily. The more difficult ones are some of these bullet points you see where there's variable payments, or the payments are based on an index like the consumer price index, or just if there's an escalation, if it's $5,000 for the first 5 years and then $6,000 for the next 5 years. In any of those cases, it's going to be a little more complicated. You can still do it in Excel, but it's going to require a little more Excel mastery. There are also just programs. Our firm uses what's called T-value, and I'll show a screenshot of that in a minute. Or there's Lease software, and I'm not sure if, has anyone actually looked at some of the Lease software? I'm just curious if there's, have you found one you like? Would you mind sharing? Lease Accelerator? Okay. I hadn't actually heard of that one. I know there's quite a few out there, but he says he's happy with that one. So I know another one I've heard of is Lease Crunch. Had some of my colleagues were thinking it sounded like a cereal brand. But anyway, there's a lot of options. I mean, depending on the size of your facility and the amount of leasing you use, that's really going to help determine whether you need to invest in Lease software. I know even that one that was using Lease Crunch, I'm pretty sure she initially sent me a spreadsheet, so I think she was initially doing it in spreadsheets. So, there's a lot that goes into that decision, and it's really if you develop a good process and you have someone that can do it all in Excel, you might not need the software. But if the software is working and it's reasonably affordable, then that might be a good option to go with. So the variable payments, you do not include variable payments that are truly variable, like if it's a printer and it's all based on the number of copies you make, you wouldn't include that. However, usually there's like a minimum amount that you have to pay for. So you pay X amount per month, and that goes up to 10,000 copies. That part is the fixed part, even though it says it's based on number of copies. But the amount you would not include in the lease liability would be the additional amount where they usually charge. So after you get to that initial 10,000 copies, you have to pay X amount per additional copy. That part would be the truly variable part, and that just gets expensed when incurred. And I'll show an example of that later, but the basic idea is if you only did 9,000 copies, you still pay the full amount. If you did 11,000, you would pay your regular amount, which is included in the lease liability, but then in that period, you would record the additional expense just for that additional 1,000 copies you had in that month. Interest rate is another one of those somewhat subjective, more challenging areas. If it's explicitly stated in the contract, then it's no problem. In many cases, or most cases, you can hopefully calculate it based on the contract itself, just based on the price, if you can find the valuation of the equipment or what you would have to pay for it to purchase it, and then look at the actual payments in the contract, you can back into the interest rate using Excel or using one of those amortization software packages. If neither of those is possible and you just can't figure it out, you do have the option of using your incremental borrowing rate. So you would have to determine if you were to borrow this money from whatever your best option for borrowing is, if it's the local bank or whatever it is, what interest rate would they charge? I will say I don't think GASB has this option, but under FASB it does. They did come out later and say you also have a practical expedient to use the interest-free rate. So you could just go online and look at the treasury rates for a similar term as the lease that you're looking at and use that rate. Again, that's just for FASB, I believe. I guess we'll get to an example in a minute, but I mean, basically all those factors we just went into, figuring out the term, the variable payments, the interest rate. Once you have all that, you can calculate the liability because you have all the pieces to calculate the present value. And the asset is really, as I mentioned, just a derived number. So you take that liability amount, that equals the asset, plus some of these other items. The lease payments made to or incentives received from the lessor prior to commencement of the lease term, and those initial direct costs. But as I mentioned, that's usually not going to apply. If it's more like a debt issuance cost, they exclude those from the definition. Yeah, here's some more about that. So you would not include debt issuance costs, and you amortize the lease asset in a systematic and rational manner. So usually that's going to be straight line. So just to keep it simple. The amortization expense can be reported with depreciation expense. Usually if we're preparing the financial statements, we usually title that line accordingly. So it would say depreciation and amortization expense. I'm going to skip through these next few slides. In both the GASB and FASB section, I have some slides on if you need to reassess or revalue or modify the contract, because these are further down the line, and I decided I should really focus today on the initial, the initial implementation, since this is the first year this new standard is going to be effective. But further down the line, if your lease is modified, or those initial assessments you make as to how reasonably certain you are to exercise an option to extend or to terminate or not to terminate. If those end up changing and you're 5 years down the road and now you know for certain you will extend the lease even though you thought you wouldn't, or vice versa, at that point you would need to recalculate the lease liability and lease asset. So that's a very high-level summary of these slides. There's a lot more detail to it, but again, the first step is getting it all recorded in the first year of implementation. So here's what it will look like on your books, at least the expenses that will be affected by the new standard. Not really any major changes. It's still going to go through lease expense. And on the GASB side, the lease expense is just going to be for those short-term leases. Everything else is going to be, because you're recording assets and liabilities, it's going to go through depreciation, or really amortization and interest expense. So the lease expense is just going to be the short-term leases. On the statement of net position, so you're going to call it something, probably right-of-use asset is what the standard recommends, and that's pretty much the same on, I believe, on GASB and FASB. So it's an intangible asset. It will be recorded with your non-current assets. Here in the example, I've shown it kind of grouped with capital assets, but you could just have that section be the non-current assets. But the point is, you do want it showing separately. So you would have your right-of-use assets and the related accumulated amortization for those assets. And then in the liability section, as I mentioned before, you will split up the current portion of the liability and the long-term portion. And so that's, again, going to create that difference between the assets where it's all in non-current and the liabilities where you are splitting those up. So our first example, as I mentioned, this is a very simple one, 10-year lease with 2 5-year extensions, $5,000 per month. But in the example, you've concluded, you have concluded you are exercising the extensions, but it is for the same amount per month. So that's making it all very simple. So in total, you have 10-year initial term, 2 5-year terms, total of 20 years. You've determined that your incremental borrowing rate, so apparently you weren't able to figure out the interest rate just from the contract term, but you've determined that your rate should be 6% and ownership does not transfer at the end of the lease. So based on all those factors, so this is our screenshot from T-value. So you would enter in those factors as the $5,000 payment per month over 240 months, and then you put in unknown as the loan amount, which would be your present value, and then the software will calculate the present value. So once you have that amount, then you can record the asset and the liability. And in this case, since there weren't any upfront payments or initial direct costs to record, it's simply the asset and the liability at the same amount. So very, very simple, and probably a lot of your leases will be hopefully fairly basic and similar to this, but we will go over some other slightly more complex examples toward the end. And then at the end of the year, as you amortize the asset, you're just, again, generally going to do this straight line. So you just take that total amount divided by the total term of 20 years, and that's going to be the asset amortization each year. So that would be the $34,897. The lease payment, on the other hand, if we go back, I don't show it here, but the second tab in this T value shows the amortization schedule. So that would show, each month or each year how much is going to interest versus how much is going to principal, and that's what you would use for that the entry to record the lease payment. And so some of that is going to the lease liability, and some is going to interest expense. And so just like you have with your current capital leases, that will affect the expense as the interest expense is higher in the early years, so the total expense is going to be higher, and that total expense is going to change over time. And that's really where there's the biggest effect on the income statement, really just for governments, because for non-governments, you're still having operating versus financing, and you're not having that same difference between interest and depreciation, and the interest being higher at the beginning and lower at the end. So really for FASB, not much at all effect on the income statement. GASB, here's where there will be. Probably not a huge effect, but it kind of depends. If you're using a lot of building leases, for example, you might have a much higher amounts and higher interest expense compared to the depreciation expense, because your depreciation is straight line while your interest is changing over time. So the amount of expense could change especially for those operating leases. hope I explained that well, but in some of the calculations we've done, it can make a pretty substantial difference for governments. I will point out, though, if you've been, I'm sure over time you've heard a few of these presentations on the lease accounting, and I'll get to this in the later slides. The good news is you don't have to go back and restate everything from the beginning, so there's not going to be a huge, what's it called, a adjustment to net assets in the first year that you implement this. I think initially when the standard came out, we read it that way and thought you know, especially if you have a lot of those building leases, and now all those operating leases are going on the books. For one hospital we were working with, we were calculating a $500,000 adjustment to net assets in that first year. But as we looked into it more, that first year of implementation, you're looking at it as of the beginning of that year, what are the remaining payments? So that initial amount you record is based on the remaining payments so if you're a calendar year in, it would be from January 1st on. So that makes it a little easier and means that really in almost all cases, you shouldn't have a restatement of net assets in that first year. The lessor accounting, in some cases, you may have a MOB or some other space that you're leasing to another entity. It's pretty simple. It's going to be the same as the lessee accounting that we just went over, but in reverse. So instead of a liability, you'll have a receivable and a deferred inflow of resources. And then again, you'll amortize that over the 20-year term for that first example we looked at. So the implementation, as I mentioned, the standard does say to apply retroactively by restating the financial statements. Both of the standards mention that word many times, restating, but the more we've looked at it, there really shouldn't be anything to restate because, again, you're looking at remaining payments from that first day of that year. And the second part, usually, I'm assuming all of you have comparative financial statements, so you're showing last year and the current year. This is just our DZA interpretation, and what we're recommending to our clients is that using this phrasing of if practicable, we think it's not really going to provide enough benefit to users of the financial statements compared to the cost of going back and recalculating the liability amounts and asset amounts for both years. And all you have to do is put a note about that, and we have some sample wording for that. Put a note in your notes to the financial statement stating why you're not applying this new standard to the prior year. So you might get different recommendations from other accounting firms, but that's kind of our stance. Is we don't believe in most cases that it is practicable or reasonable to do that extra work and restate for the prior year. So our recommendation is doing the implementation just in the first year that it's effective. So I did mention already, so we're getting into the FASB section, and the dates are a little later. The first one will be if you have a calendar year, it's this current year. And since we've kind of already covered most everything, I'll just kind of skip through and stop if I see anything that reminds me of something specific for FASB. So yeah, the lease definition, slightly different wording, but mostly the same idea. It's conveying the right to use property, plant, or equipment for a period of time in exchange for consideration. And the asset could be explicitly or implicitly specified, and that goes back to what we talked about. It could be within a maintenance agreement or a supplies purchase agreement. It does go into a little more detail in FASB, and one thing it points out is the supplier should have no practical ability to substitute the asset, so they could not just remove. One example I thought of that actually a client had a question on is those mobile MRI trailers that show up. And we concluded, looking at the agreement and looking at the standard, that would not apply, because in most cases it's on site for 2 or 3 days per week, and there's really nothing stopping the vendor, assuming they had multiple of these mobile MRIs, there's nothing stopping them from substituting it one for another, as long as it serves the same function. And so you don't really have the authority over the use of the asset or the ability to obtain substantially all the economic benefit from the use of the asset in that type of situation. So I think we talked about most of this other. As I'm flipping through, any questions that have come up so far? Any clarification needed? Just shout it out as I'm flipping through these. Okay, so I did mention, that's the important difference, is that there is the difference between finance and operating leases, and I'll go over the distinction between those in just a minute. So on the FASB side, so the non-government side, this is what it's going to look like on your financial statements. And again, there's some variation. This is the way we chose to present it. But the key points are, you are separating out the right-of-use assets, but you do have the two different types. So you'll have the finance lease right-of-use assets with their associated accumulated amortization, separate from the operating lease right-of-use assets, which don't have the amortization. So there's just one line for that. And then same in the liabilities, you do separate the two types, but you'll have the current portion and the non-current portion. And on the expense side, again, it's just, same types of categories you've always had: lease, depreciation, amortization, and interest, and the lease expense. So in this case, it would include those short-term leases if you're choosing that practical expedient, but it would also include all the operating leases. There's really no change there. You currently record those as lease expense, and you'll still do that with the new standard. And that's just how you show it on the cash flow statement. The initial recognition is, as we discussed for GASB, the present value of the lease payments. Okay, so here's finance lease. Really, it's almost identical to what you currently consider a capital lease. Really just a change in the wording and kind of the philosophy of making it a little more principles-based. So that first one, ownership transfers by the end of the lease term, and the second one, option to purchase the underlying asset, reasonably certain to exercise. So it would be called a bargain purchase option. Now it just says reasonably certain to exercise. So a kind of a different threshold there. The third one, lease term, is the major part of the remaining economic life. Under capital leases, it specifically said 75% of the economic life. So they've taken out the specific bright line thresholds, and same for the fourth one. The present value used to have to be 90%. Now it just says exceeds substantially all of the fair value of the underlying asset. So all of those they have very similar comparisons under the old standard for capital leases. However, the new standard does say you can still use those old thresholds as guidance. So if you're more comfortable doing it that way, you can always just follow what you've always done for capital leases. It does add that fifth bullet. That's a new one, that if it's of a specialized nature that would have no alternative use to the lessor at the end of the lease term, that would also qualify as a finance lease. I mentioned those items. And operating leases would just be all other leases. So the lease term would be the non-cancelable period, and I don't have it in as many bullet points as I did for GASB, but it's the same idea that you're considering those options to extend, and again, it's using that reasonably certain requirement. Oh, I don't think I mentioned that before. Under both standards, if you are using a CPI or some other kind of market interest rate, in that first year of implementation, when you're calculating the present value, you use whatever that rate is at that time. So you don't try and estimate what that rate's going to be in the future. You use the current rate so if you're paying $5,000 per month now, but it's going to go up by the CPI rate in 5 years, you estimate what that rate is going to be in 5 years based on the current index rate. And that doesn't have to be changed as the rate changes over time unless one of those other lease modification requirements happens to come up, or if the lease is modified somehow, or if your determination of whether or not you're extending or not extending the lease, one of those changes happens and you have to revalue the lease. At that point, you do use the now current market interest rate at that time. Okay, we talked about the discount rate, so you could use your incremental borrowing rate. I didn't put it on the slide, so if you're copying these slides or downloading them, you might want to add that you do have the option also of using the interest-free rate under the FASB standard. And these are just more slides on the remeasurement, if that ends up being applicable. Maybe I'll just touch on that just very briefly. Sorry, I'm trying to remember which one. Okay, this one. And I think there's something similar under the GASB one as well. But in some cases, if the lease is modified, but it's really adding a new asset, it's actually treated as a separate contract. So that's an important thing to note. And that may apply earlier than some of the other changes, especially if it's an existing lease you already have. If there's a modification and it's really adding another right of use, so usually that would be a new asset, and the amount of the lease payment is changing in a ratable, a comparable way to the addition of that new asset, that would actually be treated as a separate contract. And again, there's the option for the short-term leases. So the example one, the accounting for FASB finance leases and GASB leases is the same, so we didn't re-show that example one. I do have this example two that has a little more complexity to it. So this would be for a CT scanner. It's $4,000 per month, and that's up to 20 scans per month, and $500 per scan after you get to 20 scans. Term of 3 years, renewal has to be renegotiated, so we're not including any options to extend based on that, and ownership does not transfer. So based on that, we would consider it an operating lease. Total payments would be $144,000, and so to get the expense, you just divide the total payments divided by the time period, the lease term, and so the expense is just that $48,000 per year. And then the lease liability, you would still calculate an amortization schedule, and the liability would be reduced by the principal portion on that amortization schedule. So you could enter that in your Excel or your amortization software, and you get the present value of $131,000. So you would record that as the asset and the liability. That lease expense would just be that $48,000, which is just the total payments divided by the 3 years. But in this case, because it's just simple and straightforward and the payments aren't changing, both you can see the lease liability and the right to use asset are changing by the same amount. So they're going to be equal throughout the term of this lease. And then this just shows those variable payments. If you do 25 scans, you do have to expense that additional 5 scans because you only had the lease, the base amount up to 20 scans. You do expense that in the month where those additional scans happen. Whereas if you only have 18 scans, you still pay the full amount, and there's no change in the accounting for that month. example 3, this is where the lease payments are actually changing. So with a 10-year lease, so this is kind of going back similar to the first example, but in the first extension period, it goes up to $6,000, the second extension period up to $7,000. So this is where, okay, so we determined that that's an operating lease. You still calculate the total amount of the payments, and you still divide it by 20 years. So you still, very simple calculation for the lease expense. The right-of-use asset, as I mentioned before, it's a derived number. Basically, you calculate all the other parts, the lease liability, the principal, the interest, and the cash paid, and then whatever's left over goes to the asset. So we'll see what that looks like in just a second. So you would enter that all in your amortization software, come up with the present value, and record that. So year 1, you can see you would record the lease expense, and that's just that simple calculation of total payments divided by the lease term. The lease liability is going to be based on that amortization schedule that you create. So that's going to be the principal portion, the cash paid out, and the right to use asset is the difference. You can also see that the difference is equal to the difference between the lease expense and the cash paid. So it's some of the examples, if you're looking at the actual standard, I think they look more complex than they should be, especially once you start including in the like those initial direct costs, because it usually shows those being amortized separately. But I think this states it a lot simpler and plainer, that really it's just that derived number. Whatever's left over should go against the asset. So first year implementation, and this is another area where I don't think the slides quite tell the full story, that I think the slides make it look like we're doing comparative, but there is the option, a practical expedient, where you can just apply it in the year that it's first effective. So I think that's important to keep in mind. Lessor accounting shouldn't really change from what you're currently doing. So the biggest thing, the biggest takeaways, as I mentioned before, start looking at this now. The first step, I would say, is making an inventory of all your leases. And yeah, don't wait for the audit, or it will likely delay your audit, could result in material adjustments. So I do recommend starting right away. Developing a system, I think this is important, is not just brainstorming and coming up with some general ideas, but even coming up with your policies and procedures. Who's going to be tracking this? Assign it to a specific person. Come up with your internal controls for who's doing the calculations, who's reviewing them. Again, depending on how much you use leases, this really could be a very big deal for many of you. I think the last few years I've done. Oh, are we out of time? I thought I had till 30. Okay. Thanks. Okay, so we're about at the end. Hold on just a second. I was going to see if I had sent this spreadsheet so I could show that. It doesn't look like. If you want to see that spreadsheet, contact Cami or myself. I have my. Oops. There's the PowerPoint. There's my contact information. Happy to send that out. It's really just the first page has a listing of all the leases and the very key terms, amount of payment per month, lease term, description of the asset. And then there's separate pages we call cover sheets for each separate lease. And that has a spot where you could document your reasoning for, yes, we expect to extend this lease, or no, we don't, and why not. So we recommend using something like that, and going from that, once you have everything listed, that's really where you want to start with to determine if you might have a materiality level. We've gotten a lot of those questions, is should we have a threshold like we have for capital assets? And there's not really a one-size-fits-all for that we can say for all hospitals, because it's going to depend on if you have a bunch of small leases or just a few really big ones. and you're not really going to know that until you list them all out. So that's what we recommend for the first step. Once you have them all listed, then you can decide, well, maybe we can cut out everything over X amount, as long as it's not material in total for all the leases that are over that amount. I think probably any audit firm is going to be comfortable with that. So, sorry I went a little over. Are there any questions before I conclude? All right. Well, thank you all so much.
Thank you, Joe.